Welcome back. You're watching East Africa Business Report, the program that lets you in on the latest business and market news that you need to know about from the East African region. Now, the full impact of the global financial crisis on the East African region is yet to be fully cracked. Was it isolated or was it insulated? And what are the prospects for the region going forward? Earlier this week, I caught up with PricewaterhouseCoopers senior country partner, Kuria Mushiru, to find out more. Key findings in your report indicate that 90% of the CEOs you interviewed expressed confidence in growth over the next 3 years. How does this play out within the East African region?
Let's just first of all put it in perspective. When you talk about regional CEOs, this is a global report, but our regional CEOs, about 178 of them, participated in the survey in October last year. And the region we're looking at includes Rwanda, Uganda, Tanzania, and Kenya. And they're telling us they remain confident. And that's important to put across. They remain confident of growth in the next 12 months. Because when we asked them 12 months ago, they were confident even then. And it's interesting to see that they are remaining confident even having gone through the world economic crisis that we've gone through. And you might ask why. That's perhaps because they believe that their economies were, to some extent, insulated from the global crisis. Mm-hmm. And when you look at the performance of some of the regional economies, it bears them out. They have not been that affected.
Now, one of the biggest impacts of the financial crisis was downsizing, where companies had to cut down their human resource. But looking at your report, you say there could be a planned boost in recruitment within the next 3 years, which is an indicator of growth of the different economies. But how critical are CEOs now viewing the people working for them?
We are seeing that it did affect, because if we take Kenya for an example, the economy has really struggled for the last 2 years. And 2007 was the best year for the country for a long, long time. 2008 was tough because of the post-election violence and the drought, which then came into 2009. So Kenyan companies have downsized. And what we are hearing from the CEOs is that 77% of them admit to having carried out some sort of restructuring in the last year, and about 40% plan to do some more restructuring in the coming year. So it's tapering off, but it has happened. People have been let go, people have been retrenched. When you retrench, you may lose some of your best people, not because you retrench them, but some of the people who are left may feel unsure about the future and may choose to leave. So a CEO who's going through a tough time like this needs to focus on your best performance, also focus on your high potentials, and make sure you retain them during the difficult times.
Now, you have been quoted as saying CEOs are taking on a post-survival tactic, and one of those ways is restructuring. In what ways are companies now re-strategizing? We've seen strategic alliance, for instance, in the case of Safaricom and Equity Bank, where they're finding strategic places they can partner with in order to retain or even build or own more customers. In what specific ways are companies now restructuring going forward?
I think that is an example of some of the things you will see. There'll be more convergence between technology, ICT, mobile telephony, and banking. That must happen. Kenya maybe is one of the pioneers in this area because of the likes of M-Pesa, but that is likely to happen more and more, where the move from brick and mortar branch banking to either banking by agencies or mobile banking is likely to happen. So more alliances will come through. I think that's just the beginning of many more things to happen in that area, because people are now looking at what was previously banking and saying, how can we leverage technology and make it better? So that only means that the two sectors will come together.
Now, the financial crisis created a shift in consumer dynamics, but how do these businesses intend to woo their customers back?
One of the things that the CEOs did tell us that they're changing their strategy is really responding to customer needs, because the customers are demanding different things, and there is no one answer. Different customers will demand of you at a particular time different things. We've seen over the last 5 years, maybe even more, that in the consumer, in the FMCG sector, companies have gone to downsizing or mini-sizing whatever they're selling. because people cannot afford to pay more than 100 shillings for anything, maybe not even 20 shillings. And you've seen a lot of that happening in terms of small packaging of items. In the same way, you've seen banks reaching out to customers on the street and trying to entice them to become customers of theirs.
Now, the process of the East African integration seems to be on track. What does this region offer the CEOs, and what are their opinions about a wider market within this region?
We see that as also a big opportunity, and also it is a response to 2008. Many companies in 2007 may have made in Kenya 80%, 90% of their profit. What 2008 showed them is you need to diversify your risks. And they're looking at risk in a new way. And they're looking to reach out and take advantage of this very significant market, which could be 120, 140 million. When you look at it, if you look at the East African market together, it's as a single market. If everything we hear is going to happens, and it becomes one single market, it will be only comparable to Nigeria in terms of size. And you know the Nigerian market is huge, with, excuse me, with big opportunities. And so what we are seeing is that companies are becoming more regional. They're looking out to invest in Rwanda, in Uganda, in Burundi, in Tanzania, in Southern Sudan. That's a big push that we're seeing. And it's a reflection of mitigation of risk, because they don't want to put all their eggs in one basket in Kenya.
Kenya's property sector has continued to boom in the last couple of years, though some analysts say prices have gone through the roof and may not tally with the country's economy. Hasconsult, a Kenyan property firm, just released a property index as we speak with the experts to find out what's behind the current boom. Construction sites like this, hardly 10 minutes from Nairobi city centre, have continually shown the good health of Kenya's property markets. Price growth is intense, and the rental figures being charged for some of these properties in the most desirable areas are at par with major cities around the world. What are the factors escalating growth in the sector?
The reason for this is because most of our prices, we believe, have been driven by pure fundamentals, which is supply and demand, as opposed to speculation. And we believe that although there's been a drop in economic growth, there hasn't actually been, the construction industry has continued to maintain its very strong growth.
We have a big imbalance between the number of houses that are being produced right now and the demand. If you take the statistics back to the year 2002, we're talking about a need of 150,000 housing units every year. Yet from the market, we're only talking about 30 to 40,000 being produced annually. Now, if you count that deficit over those 7 or 8 years, we're actually saying that we are falling behind every single year. And part of the reason is because of what we would say our economic power as a country.
The winners have been mortgage companies and the banks, charging interest rates of between 10 and 19% for both commercial and residential properties.
The property boom has come about as owing to the fact that with the opening up of the mortgage market, there are more players that have come in terms of banks, and that has increased competition within that sector, and having increased competition, that has resulted in a shift in the interest rates, and effectively making the cost of borrowing a little bit lower in terms of interest rates, which has attracted a bigger segment of the people who initially were locked out because of high interest rates.
Despite the tremendous growth of real estate in Kenya, the sector still lacks an official property index to show the direction of the market. The players such as Hasconsult have gone ahead and developed one.
The Has Property Index is based on actual sold data of properties that has happened in the real estate market in Kenya since 2005. This has been based on our own data as a company for transactions that have actually been concluded. What happened is, in an effort to expound the index a little bit, we created the composite index, which basically takes market price data from across the board. So this takes all estate agents in Nairobi and properties in every market segment that have been considered. However, the focus of that has been the middle and the upper segment of the market. What this has done is basically to show the market price trends of properties from sort of the years 2005 up to 2009.
According to Composite Index and Has Property Index, data shows a steady increase in house prices from mid-2006 to 2008 and started leveling off heading towards 2009.
Largely, the global financial situation caused, of course, for one, international investment to reduce, diaspora funds to reduce. But of course that has a rollover and a kind of a snowball effect on our local industries. So spending power was much lower in Kenya. But I think more than anything, I would say the dip came from caution. It was sort of a wait and see attitude from investors. Some believe the markets would just somehow crash, which, as you know, they haven't. But I think it was just to adopt an attitude of being a little bit careful before making any investments. So you find people were holding on to funds and not putting them in real estate.
However, there are concerns that the high property prices will continue rising beyond the reach of ordinary Kenyans.
It's true that there's a lot of demand. We've seen this, as I said, in the cement consumption and other things. We're demanding a lot of homes, and this is a trend that we're seeing throughout East Africa. But the market is not able to deliver homes at the pace and at the price that people want. So there is a big shortage in housing, and professionals and the building industry are still not able to deliver. The supply chain of building has a lot of bottlenecks that make it difficult to deliver houses cheaply. So we're looking at a lot of policy interventions that can help create incentives so that the industry is able to develop. But we're also looking at enhancing the skills and exposure of people in the industry.
The truth be told, again, you must pay for sand, you must pay for cement, you must pay for stones. So without the government coming up with a program of subsidy that would encourage those who are not able to get financing loans and mortgages, without that, I think for a long time we will be still looking at housing for most of us as a pipe dream.
And while there has been speculation in certain quarters of a correction in the real estate and property markets, experts expect the upward trend to continue.
I believe things will still keep on an upward trend, but as more players come into the mortgage market and the rates become more competitive, then you're bound to find there will still be some scope for growth and rise in property prices, but it's slowing down.
I think property is still remaining one of the best investments in this part of the world. If you look at the kind of capital holding it has as an investment, if you look at the trends in Kenya, you don't see very significant rises and falls in the property market. There's been a very constant growth rate. There have been dips, but you know, they're not what people would call crashes. So I think as an investment, it still remains one of the best in this part.
Judging from the past year's trends, it is expected that the real estate sector in Kenya will keep attracting more investments and will be a keenly watched one by investors. And that brings us to the end of the program today. Remember, it is our aim to bring you the latest business and market news that you need to know about from the East African region. And we'd love to hear what you think. So write to us on eabr@cnbcafrica.com. That's eabr@cnbcafrica.com. Alternatively, you can join our Facebook group. Join us again next week, same time, on East Africa Business Report, only on CNBC Africa. First in business worldwide.